The two things that are going to be weighing on the Federal Reserve in the near term, and investors should obviously consider this as well, is trade policy, which obviously President-elect Trump can actually effectuate through executive orders. And the second thing is really fiscal policy in the longer term. And while there can be a few ups and downs in the near term with how fiscal policy evolves, over the longer term, that's a concern that's going to effectively manage how term premiums, effectively what investors want to earn by owning those longer maturity treasuries, affect on the curve. You are right to note that there has been a fairly large calibration in rates in the near term, and that predominantly has a balanced effect of where on the interest rate curve you want to be at this point in time. You probably want to be at that front end, perhaps around the 5-year point, to avoid the questions on where those term premiums out the curve are. But at the same time, recognize the fact that the Federal Reserve is still in play, meaning that they are going to be reacting to what was previously their focal point, inflation, but also keep an eye on that growth factor. And so while risk assets are priced for perfection, that to some extent there's a stretched valuation in risk assets, what we're beginning to find is that this momentum upward in risk owning yields is actually compelling from a risk reduction standpoint. Said differently, investors who are looking to diversify their portfolios and sort of avoid some of the volatility that might emanate from risk assets are beginning to find attraction to these higher yields, even in spite of the questions regarding the longer term fiscal outlook for the United States.
Yes. Jerome, so President Trump is assembling his dream team. If Scott Bessent is appointed Treasury Secretary, what are the implications then for the bond market?
So in the medium term, we're going to find ourselves in a situation where growth and inflation come into play. Those inflation mechanics are going to also be weighed in terms of where that destination is for the Federal Reserve. And granted, even a few short weeks ago, we expected that neutral rate to be closer to 3%. The market was even suggesting slightly close to that. At the same time, we've seen that move a little bit higher over the past few trading sessions. And so that neutral rate might be closer to 3.5% or 4%. But it ultimately means that you're going to have to focus on the internal data, which is to come over the next few weeks, with the longer term prospects for the economy. Remember, the Treasury doesn't effectuate the interest rate policy. They effectuate issuance of treasuries. And so we need to bifurcate as investors where the trajectory of rate policy is going to materialize from, and that's going to be the Federal Reserve. And getting back to the point made at the top of the segment, what we focus on is a steady hand with Jerome Powell, at least for the next 12 plus months, being at the Federal Reserve.
Jerome, are we looking at record issuance again? And are we looking at a digestion problem in the market with all that supply? And ultimately, is that going to be a driver to yields moving back over 5%?
That's a great point, but to subtly press back on that, what you also have to recognize is that when you have a recalibration of rates, and more importantly, digest what is going on in risk assets, which is, again, a fairly tight spread, fairly low risk premium you're going to earn in equities, what you find is that there's new entrants to that fixed income landscape. And you're finding it not just in the U.S. to bring new investors who are looking for income and looking for relative safety, but also global investors who are finding opportunities to really focus on that entry point of total return at a lower volatility footprint. And that volatility metric is really what investors are going to focus on over the next few years, especially as there's differentiation amongst the global central banks, but also as a starting point when there becomes to be a little bit more uncertainty what the economic outlook is actually comprised of. So while we sit here today and forecast at PIMCO a growth rate of about 1.5 to 1.7% in 2025, looking beyond that, given policy implications, it gets a little bit more cloudy. Again, not suggesting a hard landing, but those question marks push investors into those fixed income investments, specifically given the more attractive yield at this point in time. So expect the Fed to continue easing in the near term slightly, but at the same time, the longer term outlooks are making it more compelling for that fixed income allocation.